the most wonderful time of the year. It is also arguably one of the most expensive times of the year. Not sure anybody would argue about that. So is it even possible to balance spending and saving over the holidays? We're getting some advice and answers to other important questions, of course, from Ohio's retirement coach, Greg Taylor of Legacy Retirement Group. Thanks for being here, Greg.
It's great to be here today, just before Christmas. It's exciting.
I know, although I don't know if I want you to put me in my place with saving and not overspending on the holidays, because that seems to happen a lot.
Yeah, you know, folks get a little hall pass this time of year on the spending.
Right.
You just have to, temper it after the first of the year.
Exactly. Got to be smart about it. We know that much. So let's talk a little bit about specifically with this new year. We've got a new administration on the horizon. So what is your advice? We're going to go with asset allocation on this one first.
Well, understand that with asset allocation, we want to make sure that we are not in such a position that all of our investments are correlated. And what I mean by that is that they're all going to move in the same direction. So it's great if everything's in stocks and the stock market's going to new highs like we've been seeing, and that's exciting. And nobody wants to miss out on the best returns. That's key. But you have to understand that what comes up can also do what?
Go down.
Can also go down.
Yes.
So when those go down, you want to have something to support it. And you want to make sure that, whether it's bonds or whether it's commodities or whether it's real estate, you can't just have everything in stocks or equities. You have to have that balance. And sometimes that changes. That's why we use what we call smart investing, where we take the temperature of the economy and then we want to adjust based on how things are going. Okay.
That's the not putting your eggs all in one basket. I mean, that kind of goes for everything, is what you're saying. Okay, question 2 today. I'm considering converting my IRA to a Roth IRA. Is there any benefit to me doing that before 2017?
Well, sometimes that would be the case. And if you have any loser stocks that are in an IRA, that might be a time to convert those loser stocks over to a Roth while things are low. But right now, the markets are kind of high.
Okay.
So really, with the markets being so high right now, maybe you want to wait until we have a bit of a correction, because understand, when you convert it, you have to pay tax on it. So think about this. If a stock took a big dip, you converted it when it was low, so your tax is going to be lower. And as the market rebounds and that grows, then you get to make up for that tax you had to pay by a growing portfolio.
Okay, so you do have to weigh it out before you just make a decision.
You do.
Okay, Greg, question 3 today. With the stock market hitting record highs the last few weeks, should I move to a more aggressive investment strategy?
Absolutely not. Stay true to your goals. Because what's happened, if we let our emotions get the best of us, then we go chasing those returns. And then as soon as the market, they sort of pull those returns out from under us.
Sure.
We start to take a dip, and nobody's going to say that we're going to experience another 2008 anytime soon. But if that were to happen, we won't be able to stay true to our goals, because really we're taking more risks than we're comfortable with.
Right. And since we know 2008 is possible now and we know what can happen, we don't want to see that.
No, we don't. And emotions are what really derails most of our investment strategies. We buy at the wrong time. We sell at the wrong time.
Sure.
You don't want to buy at an all-time high. Go ahead and wait, until that next correction comes, and then put those extra dollars in there.
All right, Greg, finishing up this segment, how much would the Fed have to raise interest rates before I actually feel the increase in my savings?
Well, I think that it'll be a little bit slower to make its way to the CD market or the savings account market. But we've already seen it in mortgage lending rates. We went from the mid to high 3s. Now we're up over 4 on most 30-year mortgages.
Right.
So, on a $200,000 mortgage, that impacts us by about $70 a month. But yet, I haven't seen, any advertisements for CD rates to spring up, although there is right now, there are a couple of companies that are offering over 3% on 5-year fixed annuity rates, which is a little better than what CDs are paying right now.
All right, good to know, Greg. And of course, if you have a question for Greg, it is questions@ohiosretirementcoach.com. All right, up next, we're getting more expertise from the full Legacy Retirement duo. Kristen is joining us to walk through our year-end financial checkup.